Welcome to Chit Chat Money. On this show, hosts Ryan Henderson and Brett Schaefer interview industry experts and riff on the world of investing. As a quick reminder, Chit Chat Money is a CCM Media Group podcast. Ryan and Brett are not financial advisors. Anything discussed on Chit Chat Money by Ryan or Brett or any other podcast guest is not formal advice or a recommendation. Now please enjoy this episode.
All right, we're ready to roll today. The Sunday show. Hopefully at this point the election is done. At least if you're in the United States here, and can focus back on your normal life because we were talking to another company today, and is nCino. How are you feeling about them, Ryan?
How am I feeling about nCino?
Yeah.
I like them. It's
Okay.
a good business. Valuation's a little here and there, but I'll just get into what they do. nCino provides a cloud-based bank operating system. So nCino's goal is really to streamline all customer and employee interactions through their operating system. So they tout the transparency that the platform creates for all sides. So customer, the bank, third parties, they all get access to the same information through this cloud-based platform. And they have basically three primary components to the business. So the nCino applications, which is client onboarding, loan origination, deposit account opening, and then there's the nCino platform, which the applications were built on. So all the so the platform helps take care of business process automation, so sort of the workflow for the banks, and then compliance and risk management, and then there's the 360 client view and reporting, and then lastly is their nCino IQ. This is
It's new though, right? It's like launching this fall, correct?
I think it's launched.
They said it's like,
so.
or maybe it's in beta. They were mentioning on the conference call that it's like
Okay.
either very early days or about to launch.
Okay, so this is basically their AI, so their artificial intelligence / machine learning tool, and financial institutions can add this to their subscription. Basically, you can scan documents and immediately extract important data. They can automate loan originations and stuff like that. Basically, all the good things that artificial intelligence could do.
The banking interns are like, wow, they coming for my entire job here?
Yeah, it feels like they might be removing some of the banking employees.
Some of the grunt work, yeah.
Right. But a little bit about the history. nCino was actually started by two bankers in 2011 at one of the top small business loan originators in the country. The two bankers are Chip Mahan and Neil Underwood. And this is why they really advertise their slogan, built by bankers for bankers. So basically they were working for a bank and they were like, how can we automate this process? And I guess they were developers as well, and they did that. nCino is now headquartered in Wilmington, North Carolina, and they have some big name customers like Barclays, TD Bank, SunTrust, but then they also serve the smaller regional banks as well as credit unions. The CEO is Pierre Naudet. I might be getting that wrong. I believe he's from South Africa, and he has been there since the founding, yet he owns only 1.6%. So Here's what I'm taking away from this. It looks like they struggled to get funding initially. They had a $9 million friends and family round early on, and I'm sure it's a little daunting for a lot of VCs or seed investors to say, yeah, we're going to go in, sell to the biggest banks in the world, and uproot their entire operating system. That seems like a tall task. So, Jeffrey Horing is a representative or a managing director at Insight Partners. That's a venture capital firm. They now own 46.6% of the shares outstanding, and they got that ownership at $8 a share.
Wow.
So I have to imagine they got pretty favorable terms at some point when nCino needed the money, because right now shares are what, $77?
Yeah, $77. They just IPO'd this summer. And that kind of indicates to me that they're a low float stock right now, because I'm sure that half of those shares that are owned by that VC is in the lockup period. So it'd be, if I held the stock right now, I'd be worried that when the volume, when the lockup period ends, Insight Partners is likely going to want to sell all their shares, or the majority of their shares, to give it back to their partners for profits, because they've probably been waiting for 5-6 years. I don't know. That'd worry me if I was, but it doesn't guarantee it's going to happen.
They were the first VC in on nCino, so they got like whatever it is, 47%, basically at the price they probably chose. And then 2 years later, Bessemer Venture Partners and I think one other one came in at like 2 times the price or something.
Right.
So I've got a feeling Insight sort of exploited nCino at a bad time, but now as shareholders, it looks like they're doing all right.
Yeah, they're doing quite well. I'll reiterate all those with this valuation here. They have an enterprise value of about $6.6 billion, ticker NCNO, price $77 or around that. Trailing EV to sales is 39, which everyone knows that's very, very high. EV to gross profit is 70, again, a very high number. And then margin adjusted EV to sales is 139. That's the metric we like to use to kind of include trailing revenue growth, although when we say this number, it's not a guarantee that revenue growth will stay the exact same. That's probably something that can actually adjust quite a bit compared to the other margin metrics. That's about 140 for nCino right now, which is very, very high. If we look at the average of the companies we do, it's about 50. They have no dividend.
That was price to sales, not necessarily EV.
EV to sales, which is a little different, but still, 140 is expensive.
Right. It typically still in the range of 50 to 60.
Yeah. And then they have no dividend because they just went public. Shares outstanding are going to be increasing, but really that's just post IPO. They have about $330 million in working capital from their IPO funds. Their largest liabilities are deferred revenue, and they have really small amounts of liabilities in general. So it smells to me like a stock that you really don't have to worry about share dilution you do want to worry about share dilution because that's how they're funding a lot of their operations, but they're not funding it through debt. So it's just the give and take when evaluating the stock.
Do you know the share count, what it looks like? Did you read that?
Well, I mean, it went up a lot because of the IPO, so it's hard to tell, but their stock-based compensation, I believe, it was like 14 million of the revenue last quarter, or the first 6 months.
First 6 months, yeah.
First 6 months, which is a sizable number because of what you have here, 93 million in revenue.
So around 15 to 20%.
Which is high, but in 2019 it was a lot lower. So there might be some inflated statistics because of the IPO, people, changing shares when the company goes public.
Okay, I'll get into the earnings then. This is for the first 6 months of the year. They had $93.5 million in revenue. That's up 51.2% year over year. 79% of that revenue is from subscriptions versus professional services. The year prior, it was 71% subscriptions. That's good because the subscription gross margin is 70%, whereas professional services actually has negative gross margins.
Wow.
And so professional services is basically the onboarding, the implementation, and basically everything you're going through in the sales cycle other than going out and reaching out to the client. I'm sure that goes into under operating expenses, but sort of customer service, implementation, that kind of thing, very low margin. And then they had a negative 19 million in operating income for the first 6 months, or a minus 21% operating margin. Last year they had negative 18.5% operating margin, so going the wrong direction, but they are cash flow positive. They had around 32 million in operating cash flow for the first 6 months and 29 million in free cash flow. Most of that add back came from deferred revenue and stock-based compensation. About 40% of operating expenses was spent on R&D. Another 40% was spent on sales and marketing. It's basically split equally between those two. And they had nearly 400 million in cash following their IPO.
Yeah, not bad, not bad. And we got to hit the ad here. But first, we want to talk about our friends at 7 Investing. We say it on every show, but you can get $10 off your first month with the code CCM or using the link in our show notes. That means that your first month is only $7, which we think is a bargain. And if you use this code, it's a way to help us at the show. And it's also a way to help yourself by using 7 Investing and helping the 7 Investing group.
And they just had their new recommendations.
They did, yeah. So great timing for that. We'll hit the ad break and just make sure to sign up with code CCM. All right, welcome back. Next up is Digging Trenches. So what do you think about the Moat rating here, Ryan?
I think it's pretty high. I think it's just the nature of their business, the long sales cycles, the customer lifetime value, and how long they stick around for, and just how large their clients are, how long it takes to implement everything across all their branches makes it pretty sticky. But I also don't have a great grasp on the legacy systems and how sticky those are, or even how hard it is to switch. So it's kind of a double-edged sword in that way, but I don't think once people have switched to nCino, they're like, all right, I'm willing to switch again in a year.
Yeah, they don't have.
So a two.
They don't have economies of scale. They may have a network effect just because of all the banks working with each other on the one platform. But they probably have high switching costs because if they're going onto these giant banks with hundreds of analysts and workers and loan originators, things like that, switching to this cloud-based system is probably better than the legacy system. And then if there's nothing even close to being better, or even if there's something that's just slightly better, they're not going to want to leave nCino.
It's also not even. It's not the sexiest business in the world. Like bank operating system isn't really as appealing as some other software companies, I imagine.
It's not as exciting. Yeah.
So maybe that deters some competitors. And there's also sort of barriers to entry because you have to have a foot in the door with big banks. And, it's cost intensive to figure out all the regulatory and compliance stuff behind it.
Yeah, I'd agree. All right. Further reading, what's something that you'd want to look into if you're going to research nCino as an investment?
Yeah, who does nCino have to replace? So basically, you think about the big banks, the Wells Fargos, the Chase, how many? I forget the other two big four.
JP Morgan.
Bank of
America. Bank of America uses them, actually.
Really?
Yeah.
Okay, so I'm just curious what they use now, how hard it is for them to switch. Is this sort of a business where they're like, if it ain't broke, don't fix it kind of thing? If so, that kind of makes the sales cycle a little more cost intensive for nCino, but on the flip side, it makes them last longer as well as customers.
Yeah, definitely. I mean, it's just that double-edged sword, long lifetime value for these type of companies, but also they may have to have a lot of onboarding costs and a lot of marketing costs. So that's a give and take.
What are you looking for?
My question is, because I worry about whether they're going to run up into not having any customers to go after. So will other financial businesses, funds, investment funds, RIAs, brokerages, financial advisors, would they benefit from using nCino? They say that there's 28,000 businesses that are in their target market. I wonder how many of those they're actually going to be able to get. I know right now they already have 1,200 or something around there customers. It worries me about that. So that's something I want to research, especially with a valuation at trailing EV to sales of 40.
Yeah, and I know that they also reach out to credit unions and smaller regional banks, but I'm curious.
That's in the 28,000 for sure. So
yeah. I mean, that is how much market penetration do they have? Somewhere around a little less than 10%.
Yeah.
All right. What about future growth opportunities?
Okay, they just signed Barclays. That's a big announcement. That was in mid-October, and it's one of the largest banks in the world. If they become standard at the top 20 or so gigantic banks worldwide, I know there's about 4, maybe 8 in the United States, so it would kind of be up in that, getting close to $1 trillion in assets or over $1 trillion in assets. That seems very valuable.
Yeah.
I don't know what the lifetime value of a customer would be there, what kind of retention they can get. Can they get that expansion? The expansion rate they claim is very high, upwards of 140%. So if they can continue that, they don't have to land new customers. And if they're at these giant organizations, and they're saving these analysts so much time, they're saving, just cost from either overhead or just efficiencies with people working. If they're saving a company like upwards of $100 million a year, that's very valuable, and they could end up spending, 50 or so million.
Yeah, I'm just thinking about it now. I imagine like Wells Fargo, JP Morgan, a lot of those banks throughout their different branches have sort of an in-house operating system.
Yeah, so that could be another thing, and $50 million is a lot higher than what they're likely paying right now, and that's probably way on the high end, but I mean, it still is very valuable, and it's kind of, I don't know, seems like something that could help them drive revenue growth without getting new customers.
Yeah, I'm going to talk about nCino IQ. So this is their artificial intelligence / machine learning program. So if they can get like really solid artificial intelligence for compliance and regulatory automation, that would be huge. According to Thomson Reuters report, compliance costs for financial institutions have increased 13% year over year since 2017. I also spoke to Jason Moser this summer during my internship, and he said he used to work at a bank, if I'm not mistaken, and he said having a system where when compliance changes or there's new regulatory rules that get changed and it's automatically updated,
That's nice.
would be absolutely huge. But they also put in their S1 that sort of thing could attract more competitors because banks are willing to spend a lot for an automated software that takes care of all your compliance and regulatory needs.
Yeah, it seems like the value there it's strong. It seems very, very strong.
What about highlights and lowlights?
Okay. They're already cash flow positive. I think that's a plus. So they'll likely not need to raise more money. However, all of their operating cash flow comes from stock-based compensation and deferred revenue. Deferred revenue one's not bad. It just shows that they're getting more cash coming in than they're realizing. And if it's a subscription model, this is likely going to stay like that over time unless they stop growing at all. But the stock-based compensation one, you gotta include that in there because it is an expense and it will come back and dilute your shares. So the revenue or cash flow per share will go down over time. They say they have 147% subscription revenue retention rate thanks to their land and expand. Oh, sorry, that was your note, but I put that, I had that, I read that as well. I think that's strong. Sorry for taking yours there. But I think that their lifetime value of their contracts are very, very high, maybe $25 to $50 million if they can expand into even more things besides just that loan origination and analytics. It means the upfront costs are going to lead to high margins down the line. So maybe they have to spend a lot to onboard things like I said before, but that could lead to gross margin expansion and cash flow expansion over the next 3 to 5 years as the banks solidify themselves as an nCino user. I like that they're on the Salesforce platform for marketing. It helps them just double down on that without having to bring on a ton of marketing team. Let Salesforce do that themselves. However, that can probably lower gross margin. Lowlights, though, we discussed already. Amount of customers concerns me. There are less than 5,000 commercial banks in the U.S., and that number is actually shrinking. So, is their target market actually going down over time as they're coming up against that ceiling? That's something you really have to consider with this valuation. And then I also had a question of whether they're getting a COVID bump because everyone wants to transfer to cloud-based right now because of the work from home stuff. Is that going to be a temporary bump or a permanent one?
Yeah, I didn't see any bump in the numbers. I think revenue growth was sort of consistent across last year to
that
this
means
year.
Are they getting a COVID bump, which means that the numbers aren't as impressive as you might think.
Yeah, I know. I'm going to say no on that. And the other part that you touched on there, which kind of goes into my low light, I forgot to write down a low light, but remember when we talked with Matt Cochran and he's like, yeah, I don't think Square is going to be a huge threat to the legacy banks, but it could hurt the regional banks. I think the number of customers outstanding could come down a lot. Mm-hmm. So their sort of target market might decrease. But as far as highlights go, it's a sticky business. The customers stick around for a long time, and the sales cycle takes 6 to 9 months. So it's not like they're constantly onboarding new clients all the time. It's really tough to do. And if you think about it, if you're a big bank, you have multiple branches across the country. Let's say you're implementing a new software system for all those branches. You have to have tutorials at every branch showing people how to do it. That's costly. And so it's a more detailed partnership than just some software as a service companies.
Yeah, and you have big commercial offices in New York City, LA, Seattle, San Francisco, all the big Chicago. You have those all throughout the country, and maybe even internationally. That's something as well.
Yeah, they have demonstrated though that the land and expand model that they're offering, where they kind of get the customers and then add on all these adjacent products, is working. Like you mentioned, they have the 147% subscription revenue retention rate. That's really high, and that shows that a lot of their banks are using their adjacent products as well.
Yeah, but that also shows to me that the 47% of their revenue growth is of that, what was the total, 52%? So only 5% of it is from new customers. Yeah, it's great. 47% is great. But how long can they do that? That's something an investor will have to decide.
Yeah, and I imagine because the new customers are so slow, they're probably getting, maybe it's cheaper prices at the start, but also they're not like doubling their customer count in a year. That's just not the nature of this business. And so it's going to be big clients long sales cycles, long lifetime value, but they spend a lot of money with them.
Yeah, so that retention number may be the most important one for investors to follow. All right, last question before we head out of here. Are you more or less interested in nCino?
I really do like the business. The valuation is hard to get around, and yeah, it's just one of those where you're kind of in the middle ground where you love the business so much, but I guess everyone else does too, and so it doesn't feel like there's much of an inefficiency there.
Yeah, feels
I'm
like a
pass
great
on it today, but
yeah.
it's it's definitely something that goes on the watch list if there's a drawdown. Probably one of the first ones I'd add to.
Yeah, I'm definitely less interested solely because of the valuation. 40 EV to sales is high, especially if you are not taking out a giant market opportunity and you're not growing that revenue that quickly. So the narrative can turn on you, and there's no margin of safety priced into the stock. I would love that if it ever came down to a trailing EV to sales of 10 to 12. That would be fantastic because I think that's where you can get a lot of value here. But that is a long ways away. So it's going to go on the watch list because I think it's a great business, but a lot of people think that.
Everyone thinks it's crazy to be like, well, you're waiting for a 70% drawdown. Like these things happen.
I am waiting for that.
And I'm sure you could find a lot of SaaS businesses in the range from 10 to 15 EV to sales in March and
or lower.
So I don't know. I don't think it's too crazy to wait.
No, definitely not. All right. That's going to do it for this episode. Thank you all for listening. Use our promo code for 7investing CCM at checkout to get $10 off. Remember, we are not financial advisors. Anything we say on this show is not formal advice or a recommendation. Email us at chitchatmoneypodcast@gmail.com for any show recommendations, or DM us at Twitter at chitchatmoney. Thank you all for listening. We'll see you on our next episode.